Morning everyone, and a very warm welcome to this latest Bishop Fleming webinar. I'm Paul Seymour and I'm Marketing Director here at Bishop Fleming, and I'm going to be your host and moderator for today's webinar. This webinar is our regular Unscrambled event, which for the first time we're delivering virtually, and I'm pleased to welcome our panel of speakers, John Talbot, Steve Martin and Wendy Andrews, who will be taking you through today's content. As ever, we'd like to make this session as interactive as possible. Most of you will be familiar by now with Q&A functionality on webinars, but depending on somewhere on your screen, you will find a Q&A icon which will reveal the Q&A panel. This will enable you to post your questions, and please tick the anonymous box if you would prefer. Please feel free to send in your questions and we will endeavour to get through as many as possible. Just by way of a small brief disclaimer, I should point out that this webinar is designed to offer general discussion and information only, and you should always seek financial appropriate advice where necessary. Please also note that today's webinar is going to be recorded and a recording will be available to watch in due course. And finally, it goes without saying, if you need our help during these challenging times, then please do reach out to a member of the Bishop Fleming team or a member of our guest panel today. So I'm going to hand over to John Talbot now, so I'll be back in a bit. Please do keep those questions coming in, but for now, over to John. Morning, John.
Thank you very much, Paul. So first of all, thank you very much for joining us today, and I'm really pleased to also introduce Wendy and Steve, who will be joining me as we discuss several really important topics, but primarily focused around Brexit. We've been very focused on COVID this year, but the reality of Brexit has not gone away. And even now, as we look at some of the surveys and reports coming out, there are a concerning number of companies who have not yet prepared for Brexit. I guess given the delays over the last few years, it's not entirely surprising, but whilst discussions and negotiations are continuing, it's reasonable to say that Brexit is going to be a reality. The departure date of the 31st of December 2020 will not be changing, and therefore we do need to get ourselves readied and start preparing for what that holds. And our best estimate now is that we will not be having a free trade agreement on exit day. And that has got some really important implications on a huge range of areas, one of which is the very practical area that will touch many businesses and many consumers very early on, which is VAT. And that's where Wendy comes in. Wendy will lead us through some observations around the impact of VAT and some of the key considerations for both businesses and consumers as they import and export to the EU. Wendy's got many years of experience both with HMRC and in the profession, so is very well placed to give that oversight. Now, whilst much of the tax-related impact of Brexit is understandably focused on VAT, my colleague Steve will then pick up on some of the potential corporate tax consequences of Brexit, and then also touch on a few more general tax update points. And then we'll come back to myself and I'll pick up on some of the financial reporting implications from Brexit, as well as some other changes which are occurring in the world of financial reporting. So without further ado, I'll now hand over to Wendy, who will lead us through a VAT overview. Thank you, Wendy.
Thanks very much, John. Morning, everybody. And yes, as John says, the 1st of January 2021 is fast approaching now. And following a couple of false starts of deadlines over the last couple of years, it's now very, very certain that we will leave the single market and the customs union of the EU on the 31st of December this year. And there's still an awful lot of uncertainty around. Brexit's a very wide-ranging issue which will affect lots of aspects of businesses, and I think what's really important at the moment is for businesses to be focusing on what's controllable and what they do know about, and B, probably on the things that are going to hit in the short term, the shorter term focus on effects. And that really relates mainly to the trade in EU in goods, because that's the big change that happens on the 1st of January 2021, is that there starts to be a customs border between the UK and the EU, which there hasn't been for the last 25 or 30 years. So that's an actual physical difference. It won't be possible anymore for a lorry to drive from Bristol or wherever to France or Germany or anywhere without having to cross a customs border. So I'm going to talk a bit more about the the practical implications of that, because as I say, in the world of uncertainty about exactly what things are going to look like, one thing is certain is that there's going to be a customs border, so that's a good area to focus on because there are practical steps you can take. So I'll start by looking at business to business goods moving from the EU into GB. So that's your typical purchases from an EU supplier, which will need to move from that EU supplier into GB. And there'll be lots of changes. From the supplier's perspective, they'll need to make sure that they do correct export documentation. And everyone will need information in order to do that customs documentation. You'll need an IORI, which is the international version of your VAT registration number. You'll need to know the commodity code for the goods that you're moving, and you'll need to know the origin of those goods. Those are all pieces of information that were much less important within the single market. And a further issue, which is causing quite a lot of the complications, quite a lot of the thought at the moment, is Incoterms. Incoterms are the terms on which goods are moved internationally, and they determine who's responsible for customs documentation and who's responsible for customs duty in particular. Historically, within the European Union, Incoterms haven't been important because there wasn't a border. But now, as that border sort of comes crashing down, everyone's looking at contracts and trying to work out from those contracts who in the supply chain will be responsible for the importation of the goods. And I'll come back to that in a bit more detail in a second. So in terms of goods arriving in GB after the 1st of January, HMRC in the UK are having some kind of easements to make things easier for goods coming in. And so there will be a facility to make delayed declarations up to 6 months in which to report an importation and to pay any customs duty which is due on it. And then there's a sort of staged introduction of some of the inspection regimes, for example, for animal products, which will start from the 1st of April 2021. So it's quite important if you're importing from the EU to actually look at the timing of what you'll need to do. So if I go on to look at goods moving into the EU, again, the same things apply. There'll be a customs border once again, so you'll need export documentation from the UK. And then you'll need to deal with an importation into the EU. And that's the importation into the EU is kind of dealt with on a country by country basis. And that's where Incoterms become very important, because I've come across a number of UK businesses who have been selling goods to customers in the EU on what are called DDP Incoterms, delivered duty paid. That didn't matter, that was fine within the EU, it worked perfectly well. But once you've got a customs border, you've got a UK business which becomes responsible for importing goods into the member state where their customer belongs. And that does need quite a lot of thinking through and quite a lot of planning about how that's going to be dealt with. If you're dealing with these international goods transactions, probably important to make sure you've got a customs or freight agent, because they're the people closest to the logistics aspects and closest to the detailed documentation that you'll need to be thinking about. So as I say, potentially there will be customs duty and VAT on goods when they arrive in the EU, which either you might be responsible for dealing with if you've got the wrong Incoterms, or which might add to the cost of the product for your customer. Again, something that you'll need to think through from a commercial perspective. And that customs duty cost is really one of the first times when we actually see what the impact of a free trade agreement would be. Because the customs border and everything will still happen even if there is or isn't a free trade agreement. The main difference in a free trade agreement is whether or not there's any customs duty on the transactions. From the EU perspective, I mentioned earlier that the UK will have some special rules and delays about declarations, etc., to deal with the 1st of January deadline. From the EU's perspective, the UK just becomes a third country with effect from the 1st of January. I haven't seen yet any countries having any particularly easier requirements for documents, etc., in the EU. So that's quite important to remember. And from a logistics perspective, obviously the Dover-Calais ferry crossing and the tunnel are a huge focus for all the goods transactions between the UK and the EU. And as a result, I'm sure you'll have seen some of the publicity around what's likely to happen in Kent. Huge lorry parks potentially for the queues of lorries, and actually a potential special entry permit for lorries driving into Kent to check that they've got the right documentation to be able to get on the ferry and cross the channel. So quite important details to be thinking about if you are moving goods into the EU after the 1st of January. Okay, go on now to talk about business to consumer sales into the EU, because that's a fairly complex area and worth thinking about. So if you're a UK based online internet retailer selling to EU consumers, at the moment you'll send your goods directly to your customers and you'll account for UK VAT or possibly some EU VAT if you've got significant sales, but either way you'll be responsible for charging VAT on the sales to your consumer customers. And that's something that changes again quite dramatically once you've got a customs border between the UK and the EU. Once that happens, the good news is that the goods will be zero rated for UK VAT, so you won't need to charge any UK VAT or other EU VAT on those sales. They'll be zero rated. But the bad news is if you don't take any other action, your customer, your consumer customer, will be responsible for the delivery of the import into the EU. What that means in practice is instead of your parcel just being delivered onto the doorstep of your customer, they'll get a ring on the doorbell or a card through the door saying that they can't take delivery of the goods they've ordered from you until they've paid over the VAT and potential customs duty on those goods. So that's potentially a big problem, because an EU customer who's had to do that might not feel like going back to your website again. So important area to establish and to be thinking about. There is some good news on the horizon, but unfortunately it doesn't start from the 1st of January. So the EU is going to have a special scheme in place from the 1st of July 2021, which is going to allow online retailers outside the EU to have a special registration which allows them to pay EU VAT and any duty, stick a sticker on the parcel, and it can then pass through customs into the EU with nothing further needing to be done. So that will obviously be a solution from the 1st of July, but it leaves a 6-month gap when that won't be the case. So you might be happy rather with your customers paying the VAT themselves before they take delivery during that period, or you might want to do something else. And there are two main options to deal with that. Some couriers, the big transporters, the big logistics providers, are able to deal with this issue on behalf of UK sellers. So worth exploring with your shipper whether they'll be able to do that. And the only other option to think about is potentially actually holding the stock for the UK, for your EU market, transferring that stock and somehow holding it inside the EU. But that's obviously quite a big decision to take and quite complex to think through. So just finally, to highlight, next slide, please. Thank you. Finally, just to highlight some of the complex issues I'm seeing arising. And I would say, although generally over the last few years, businesses have been relatively slow to think about the specific implications of them for Brexit, and not surprisingly so, because there's been so much uncertainty. Certainly probably since about September of this year, and despite the COVID complications, businesses are really now starting to focus on thinking. And to be honest, it's different for nearly every business. Every business has a different commercial issue to think about. So it's quite difficult to provide generic guidance. It's usually a matter of talking through how an individual supply chain works and what the implications will be for it. So, for example, for some businesses who will need to act as the importer into the EU in order to make their supply to their customers, there's a potential need to set up a local entity within the EU. So that's something which people are starting to do. And also anyone who's got any sort of complicated supply chain issues within the EU will need to look very carefully at that. The two examples I've come across recently are where call-off stock belonging to a UK business is held in the EU. That's currently subject to a simplification, which avoids the need for local VAT registration. Those rules will change once the UK is not a member of the EU Customs Union and Single Market. And then the final EU simplification for triangulation. Again, if you buy some goods from a supplier in Germany, sell them to a customer in France and just get the goods moved from Germany direct to France without coming into the UK, you've been able to use a simplification, again, to avoid the need for a German or French VAT registration. Again, that won't be the case anymore after the 1st of January. So anyone who's involved in those kind of transactions is going to need some thinking through what practical solutions they can put in place to avoid issues with those transactions. So that's all I had to say. Are there a couple of questions?
Thank you, Wendy. Yep, we've got questions coming in, and unsurprisingly, Wendy's talking quite a lot at the moment on webinars. So unsurprisingly, we've got lots of questions, and we've had lots of questions. So do please keep them coming in. We've had one question from Patricia Mitchell. I think you may have answered this, Wendy. I think it came in just as you were about to speak about that. But is there anything you want to add about Patricia's question? What about customs duty and VAT on the import for goods sent to the EU by post?
If it's a B2B transaction, I think there are some special. As I'm just trying to think again. No, sorry. Again, I mean the principle would be the same. Again, if you're sending the goods B2B into a customer, the customer would be responsible for accounting for the VAT and any customs duty. It's just a B2B customer would be expecting that much more than a consumer customer.
Thank you. And a couple of questions from myself, actually. Just going back to the beginning, you talked about customs borders. One of the most contentious issues is custom border, and in particular between Ireland and Northern Ireland. So what about trading with Northern Ireland?
Yes, thanks, Paul. I'm glad you mentioned that, because as I was talking, I was very conscious that I was using the terms GB and UK interchangeably when that's not actually the case. Post the 1st of January, those two expressions are going to have to be used very carefully. The UK is England, Scotland, Wales and Northern Ireland, and GB is England, Scotland and Wales. And the huge issue that's still really to be resolved in the Brexit negotiations is the relationship between Northern Ireland, the Republic of Ireland and GB, because no one wants a physical border on the island of Ireland. So really one of the sticking points throughout the last 4 years has been how to deal with that. And there is going to be some kind of compromise. It's not definite yet. But if you're moving goods from GB into Northern Ireland, it's likely that you are also going to need to do some kind of customs documentation in respect of that transaction. And the same for moving goods out of Northern Ireland and into GB. So those are very specific transactions. As I say, it's not certain yet how those are going to be handled. The government's putting a lot of funding into Northern Ireland to allow Northern Ireland businesses in particular to get specific guidance on how to deal with things, but that's very much one to watch out for.
That's great. The questions are flooding in, unsurprisingly now. So I'm conscious that we've got to get through the other speakers, and we will get a chance to revisit some of the questions afterwards. So thank you to Nikki and Amy and the other questions. I'll pick those up at the end of the seminar, but I'd now like to invite Steve into the seminar. Steve's going to talk about indirect taxes and the impact of Brexit.
Thank you, Paul, and good morning. Good morning, everybody. So I think we've got a sense from Wendy about the importance of our presence in the EU as far as the VAT and customs duty rules have been. My focus is going to be talking about the direct tax position, and in general terms, the laws relating to do direct taxation have largely remained governed by member states rather than by the EU. What is needed to be done is the EU has got some fundamental freedoms, and they needed to ensure that those wouldn't be infringed by tax law dictated by the member states. So the freedoms which are most relevant when looking at direct taxation have been the free movement of capital and the freedom of establishment. So to tackle that potential problem, the EU issued a number of directives to protect the freedoms. And I think it's important to understand the context of the hierarchy of the tax system to see where those directives have fit in, whilst the UK has been a member of the EU. So tier 1 of our tax system is our domestic law, which is set by the UK government. Tier 2 is the collection of double tax treaties which are negotiated between the UK and another country's government, which broadly set out taxing rights where potentially both of those countries could look to tax the same income. And the way that it's worked is that if a double tax treaty contradicts UK domestic law, the double tax treaty rules have to be applied. We then get to tier 3, which is the EU directives. And if we apply the logic of a game of whist, an EU directive would trump both the double tax treaty and domestic tax law. So that's how it all fits into context. And it means that EU directives have played a very significant part of the UK's tax system whilst we've been members of the EU. So looking firstly at the on the next slide, the parent subsidiary directive is probably one of the key directives which has governed the way that groups have been able to eliminate double taxation. And this is a directive which focuses on the repatriation of profits within corporate groups across the EU. So how does the directive work? Firstly, it says that withholding tax cannot be deducted on dividends paid across border. And second, the recipient of a dividend is either exempt from paying corporate tax on that dividend, or there is a tax relief mechanism for any overseas profits tax that may have been paid overseas. So where are we going to be when we finally leave the EU? When the transition period ends, we lose that third tier of our tax system, which broadly means that we're going to be left with what the domestic tax law says, both here and in the relevant country overseas, as well as what the double tax treaty says. And that will dictate whether there's any tax due on profit distributions within corporate groups. So if we look at what the UK has got left in its locker in terms of tax law, withholding tax on dividends paid to shareholders was abolished many years ago in the UK, so there is effectively no withholding tax payable in the UK. And interestingly, in 2009, sort of independently of this directive being in place, the UK introduced a wide-reaching dividend exemption. So the majority of dividends received by UK companies are not taxable here. So effectively, we've got a mirror image of what that EU directive is in our own legislation. So sort of so far so good. If we don't have that tier 3 law, does it matter? The potential problem is that other member states do not have such a generous tax regime as the UK does. So if we were to look at an example like Germany, that country does levy withholding tax on dividends paid to non-residents, and the tax rate is around about 26%. So that's 26% less income that will be paid to the UK from a German subsidiary under the domestic law, so it's tier 1 law. The double tax treaty between the UK and Germany does offer a better term, but there is still a residual rate of withholding tax. So from the 1st of January, if you have a European group structure involving Germany, you're now going to have to think about tax leakage. And I think that's quite an important point that doesn't seem to have been picked up in a lot of the press coverage. Moving on to another directive which is really important is the Interest and Royalties Directive. The premise here is that interest and royalty payments between group companies of different member states shouldn't be taxed any less favourably than payments between group companies in the same member state. And what this usually means is that withholding tax cannot apply, and the requirement is not necessarily to have a group, but simply to have a 25% shareholding relationship between the companies. Now, again, looking at what the UK position is, we have a domestic rate of withholding tax on interest and royalties of 20%. So in principle, there would be a 20% tax payable into the UK government on interest payments as of 1st of January. But because of the EU directive, we had to include a special provision in our tax law to say that if that interest is paid to an EU member state company and there's a 25% shareholding relationship, the UK cannot charge withholding tax. So again, we have a mirror image of the EU directive in UK law, and that will continue to exist as of the 1st of January. And you know that will exist and remain valid unless and until UK legislation changes. But again, the potential problem is that from the 1st of January, you have to look at what the other side of the coin is. So interest and royalties paid to a UK company will be subject to whatever the overseas domestic tax law and relevant double tax treaty says in that other country. So if I pick another example at random, Italy has a domestic rate of withholding tax on interest which is paid to non-residents of around 26%. But the Italy-UK double tax treaty still has a residual rate of withholding tax, which is usually 10%. So again, you've got a situation where interest could have been paid from an EU country into the UK without having a withholding tax leakage. Now you're potentially going to have one. So it really does need to be looked at. The final directive, which is potentially relevant to corporates operating in the EU, is the Mergers Directive. So the principle here is that a group cross-border reorganisation shouldn't trigger a tax charge ultimately until operations either cease to be carried out or are transferred out of the EU. So if you're transferring operations between member states, there shouldn't be a tax charge payable. A typical example that probably comes up more often than not in practice is a UK company which has set up a branch or permanent establishment in the EU. And if you make a decision to incorporate that branch into a legal entity as a subsidiary, the directive will prevent corporate taxes being payable both in the EU country where the branch is established and the UK. So it gives a double relief from the taxes. And the way it works is that taxes tend to be deferred until those operations cease or are transferred out the EU if they are. Now, the way that this works is the UK Treasury, in the example of a branch being incorporated, that results in assets effectively leaving the UK tax net, because whilst operating as a branch, the UK still has taxing rights over the profits of that branch. Once there's a subsidiary, the majority of its taxing rights disappear. So the UK has probably not been that comfortable with the idea of not charging when assets are leaving the UK tax jurisdiction. But the main thing is that up until now, you could have done that very legitimately, not incurred any type of incorporation charge or taxes there. But from the 1st of January, what is the likelihood of the UK accepting that there should be no tax due on that sort of activity? I think it's probably quite likely that UK will look to address the balance there. And equally, EU countries may also want to impose tax on reorganisations where the UK is involved, because why wouldn't they if they have the ability to, because they no longer have to follow that merger directive. So I think the key messages to take home here, these directives will have given some valuable tax relief for a lot of structures operating across the channel. But such has been the focus on Brexit, VAT and duty that there's been very little press coverage on this. And I think the examples I've given of those German and Italy rates of tax which might start to apply hopefully bring that squarely into focus here. So anyone who has a presence in mainland Europe should start looking at these structures to consider any tax leakage. The other key point is that even if the double tax treaty provides a rate of 0 tax to apply on things like interest and profit distributions, that's not quite the end of the story. So in order to access the rate that's in the double tax treaty, you do need to make a formal claim. And the process is that that claim gets sent to the UK tax authority and the overseas tax authority, and has to get that completed and stamped and approved. That process can take a number of months to get done. So please do think about this now, not on the 1st of January or not the day before you want to do something that might trigger a charge. You can't arbitrarily apply the double tax treaty rates. And of course, do get in touch with us if you have any questions. We'd be happy to help you. The final thing I wanted to talk about is Social Security. Again, something that hasn't really been talked about much in the press. And I think this is really important. So at present, we fall within the multilateral agreement for member states on Social Security, or national insurance as we know it. The two main principles being that you should only be making contributions in one country at any one time. And ordinarily that should be where you're performing your duties. But there's a very key exemption that says if someone is working abroad for less than 2 years, they can continue to make contributions only in their home country, i.e. not the territory where they're working. So that seems like a pretty sensible approach to have on Social Security. From the 1st of January, that disappears. So we revert to a very old network of Social Security agreements, which are so old that they're really just not fit for purpose. So for instance, they were only intended, those agreements, to last for a limited time, which is now past. They don't adequately deal with healthcare, so they really are quite ancient. And there is potential for contributions that you would be making in certain countries not to count towards your state pension on retirement. So there are some key points there, and employees are potentially going to be really affected by this. So as employers, I think the key messages are to review any EU workforce that you have. Look at how long employees will be working overseas to see if there's a material issue to be addressed, and also look at what those local requirements are in the EU for Social Security. And you know, a little bit like the message for the corporate, make the changes now that you need to, because from the 1st of January this is going to be relevant. So I think I've talked enough about Brexit direct tax, and happy to pick up questions that have come in. I'm now going to give a brief update on UK tax changes for this year and the immediate forthcoming. And I'm trying to stay clear of the many measures and financial packages that the coronavirus crisis has brought in. And what I would say on that front is that we have a comprehensive and incredibly detailed knowledge hub on our website that covers the latest announcements last week in terms of extension of furlough, lending facilities, etc., etc. So please do visit that if you have any questions on coronavirus. But for now, I'm going to concentrate on the largely non-COVID related tax changes, and looking at property taxation as a general area. The first measure, which is probably the headline tax change for the year that we're in, it was introduced to try and stimulate during COVID, but it's the stamp duty land tax exemption. So this applies a rate of 0% on the first £500,000 of spend on a residential property purchase. So it's effectively worth £15,000 in actual cash terms. That remains in place unless it's changed until the 31st of March. But it's important to remember that if there's a 3% supplement which will apply, and that applies for second property purchases, that will still apply. So you don't have a 0% rate on buying a second property. And companies acquiring residential properties are also required to pay the 3% supplement too. So that's if you're using a corporate vehicle to buy a residential property. Also on property matters, there's another important point here is about taxable gains arising on disposals of UK. That now needs to be reported to HMRC within 30 days of the disposal, and that's quite a significant change. It's an administrative burden, but also that could very easily be forgotten in the hysteria of moving house or buying a property. So the thing to remember is that if you don't have a taxable gain to report, perhaps because it's been your private residence and you haven't got any element of gain, then you don't need to report that. But I would recommend checking with your usual Bishop Fleming advisor to just be certain that there isn't a report that needs to be made. Moving on to corporate and company matters, there's a few changes worth covering here. So budget 2016, that seems like a very long time ago, that promised us a rate of 17% for corporation tax, and that was meant to come in April this year, but by the time we got there, which is many years later, it had vanished. So we remain at 19% as the rate of corporation tax. So as well as having the practical effect on your taxable profits from now, this will also impact any deferred tax balances that perhaps you've got on the balance sheet. So liabilities for deferred tax will now need to be recognised at 19%, when perhaps they were recognised at 17% up until now. So there's a 2% differential that could hit the balance sheet there. A relatively new allowance has already undergone a change. So the structures and buildings allowance, which is the revamped industrial buildings allowance, for those who can remember that. This was introduced for expenditure on new commercial buildings or the renovation and conversion of existing commercial buildings. And it effectively gave companies a 2% capital allowance for that sort of spend, which applied from October 2018. From April this year, that rate has increased to 3%. So it's not overly generous, and it will now take you just the 33 years to get full tax relief for your spend on the commercial buildings rather than 50. It is nevertheless an improvement on the position that was there previously. Research and development has seen a couple of changes too. So the large RDEC regime for large companies in the main, a claim is now worth 10.5 pence in the pound rather than 9.7 pence in the pound, which can be a significant difference if we're talking about a very large claim. The important point to note on that RDEC being a large company regime is that SMEs also are potentially impacted here. So if an SME is carrying out R&D using state aid funding or is perhaps being subcontracted to, then there is an opportunity for SMEs to be subject to the large company regime, even though they're not a large company. So it won't just be the big boys who potentially benefit from this change. Another change which is intending to come in from April 21, which was proposed a number of years ago, is that SMEs who are using the R&D reclaim process, as in terms of repayments from HMRC, the amount that they can actually get paid back to them from the government will be capped based on the total PAYE and NIC bills, so a three times multiplier of your PAYE cost. So this is potentially going to impact businesses that don't do any R&D on their own behalf but subcontract everything out. Where it's interesting is that 3%, that 3 multiplier test applies to the total PAYE and NIC bill, not just the PAYE bill of those who are carrying out R&D. So that's an important point to note. But certain businesses just need to be careful that they're not caught out there if they're going to have payments capped, that they are aware of it. And potentially there are things that could be done to minimise the impact of that too. Finally, in the world of personal taxation, the bad news is that entrepreneurs relief has gone. Don't panic, it's just been renamed, and it's now called business asset disposal relief. And I think this was because there were a lot of entrepreneurs who weren't able to access entrepreneurs relief, and it was a bit of a misnomer. So that's a minor change. The more significant change is that the lifetime limit, so previously you could get £10 million worth of capital gains subject to the entrepreneurs relief rate of 10%. That has now fallen to £1 million. So there's a £9 million fall there, which is quite significant. but it still is a limit that applies on an individual basis. So there is a possibility of, say, using a spouse's allowance in certain ways. That can be a very effective tax planning tool. So please let us know if there are circumstances where you're expecting to breach the 1 million on a personal basis. There's much publicised and much fear about the IR35 changes, those involving personal service companies. That has been on the books for a number of years, and from April 21 that is going to be introduced. So this is a change in the onus of who takes responsibility for assessing whether PAYE should be payable. And up until now, if someone has been using a personal service company, the majority of that assessment lies with the personal service company, not with the end client or end user, as HMRC describe it, so not with the customer. From April 21, it will be the customer who will be making that assessment. So they're bearing the risk of getting it wrong, effectively. This was changed in the public sector a few years ago and brought about some pretty significant changes. So as well as expecting a lot of change to happen, we suspect that a lot of circumstances have been altered already. We have a specialist employer solutions team who can be on hand to help any questions that you've got around the IR35 changes. So that's a whistle-stop tour of the tax updates. Probably the only final thing to mention is from a personal tax point of view, if you have taken advantage of a tax deferral for your self-assessment, be aware that the 31st of January is likely to bring quite a sizable amount of tax that you will have to pay. That sort of goes without saying, but please don't forget that is pretty crucial. So now I'm going to hand over to John, who will talk about financial reporting.
Great, thank you very much, Steve. That's great. I'm now going to run through a couple of areas. First of all, starting off with Brexit and some of the implications that has on financial reporting. I think it's fair to say it won't impact many, but for those that it does impact, it could be quite significant. The first area just to mention is around the audit exemption by parent guarantee. So currently, subsidiaries of groups with a parent in the European Economic Area, so the EU, Iceland, Liechtenstein and Norway, not Switzerland, can claim an exemption from audit if the parent undertakes to guarantee all outstanding liabilities of the subsidiary and all the shareholders, the members of the subsidiary, agrees to it. Now, that's a really practical and helpful provision for aiding the administration of groups, and we do see it taken advantage of relatively regularly. What will Brexit do to this? Well, the upshot of all the discussions and amendments that have been proposed is that if the parent issuing that guarantee is a UK entity, then nothing changes. But if the parent issuing that guarantee is based outside the UK in the EEA, then that guarantee will not be available for accounting periods starting from the 1st of January 2021. So if you currently take advantage of that audit exemption within your group, then you will need to plan to change your audit approach and strategy. Now, there is one potential solution here to mitigate some of the impact there is that if you have a vertical chain of companies in the UK as well as in Europe, it may be appropriate that you apply that guarantee at the UK topco level, albeit it will require that UK company to prepare consolidated accounts and have an audit on it. So it's not a complete solution, but it could mitigate the impact. Moving on, where you have a dormant company in the UK that takes advantage of the exemption from preparing and filing its own accounts because it's part of a group with an EU parent, that exemption will only continue to apply if that parent is based in the UK. If it's based in the EU, it will no longer apply. So you'll need to prepare and file company level accounts. The Brexit, as we've heard from Wendy and Steve, has got a lot of impact on the supply chain, customer market access and so on. When it comes to drafting your strategic report at the front end of your statutory accounts, you need to outline the principal risks and uncertainties of that the business is facing, and it may well be that as the landscape unfurls, that there will be risks and uncertainties that you need to disclose here around the business model, and also potentially around areas such as GDPR. So for companies where consumer data is really important, you may well have a significant risk attached to how you'll be able to do business with the EU. I'm not going to go into the ins and outs of GDPR now because that's the subject of a whole separate seminar, but that's just another illustration. Finally, in terms of Brexit, we're not currently anticipating there to be any significant divergence between the current reporting environment, and my personal view is that I'd be surprised if we did see much divergence in it, certainly in the near future. So that's the areas I wanted to cover off on Brexit. So I'm going to now go back to the other hot topic of the year, COVID. And COVID has had a number of impacts and continues to have a number of impacts on certain areas of financial reporting. First of all, I'm just going to touch on going concern. When the pandemic started, there's a huge amount of uncertainty about the ramifications of COVID on the global economy and on many companies. One of the implications of that was that for many audits being completed around the April-May time, there are a large number of what we call material uncertainty regarding going concern paragraphs being included in the audit report, which is really reflecting the level of unpredictability that was felt at that point about the future. What we're seeing over the summer months and into the autumn is a steady reduction in the need for these paragraphs as companies gain more and more experience of operating in a COVID world, although they are still appropriate for some situations. It is an interesting area because we do see different firms taking slightly different stances on this assessment. Another area that COVID is impacting from a financial reporting perspective is that of fair values. So the most common impact here is where a company is carrying land and buildings at fair value, at current valuation, rather than historical cost. And what we saw is many valuers started issuing reports which had what they, in their words, material uncertainty statement against those valuations, which on one level was understandable, but it nevertheless meant that both the directors and the auditors had to then collectively reflect on what that meant and what that implied for the numbers which were disclosed within the financial statements. Now, anecdotally, it seems that the number of these paragraphs being issued are reducing, and that's probably because there's more and more of a track record of property transactions being conducted in a COVID world, being able to be referenced. But it is an area just to make sure you discuss with your valuer and your auditor early on so you can agree the approach and appropriate disclosures. Accounting for the various support that has been offered due to COVID is widely covered within our website, which Steve mentioned. But just a couple of things to mention very briefly. First of all, there's an announcement very recently to that if a company received a rent concession on its property, so for example a rent-free period or a rent reduction, that should now be offset against the period that benefit is being gained rather than the remaining lease length. So, for example, if you've got a 5-year property lease, you have a rent-free period for 3 months. Well, that 3 months of rent-free is now reflected in that year rather than being spread over the remaining lease length, which is an important clarification. One other point that I just wanted to mention as well is with furlough payments, they should be accounted as income rather than a cost offset. So they should be considered as essentially the same as a government grant. In terms of the financial statements, we talked around Brexit and how that should be reflected within the principal risks and uncertainties section. Similarly, COVID should be as well. In the vast bulk of financial statements would have some sort of reference to COVID, how it's impacting and how it's expected to impact the business model. linked to this, your accounting policies will almost certainly be having a going concern accounting policy now if they haven't previously, and that should include some of the key considerations that the directors have made around assessing their outlook over the coming 12-18 months or so. Both these areas should be as customised as possible. The steer that we're getting from the regulator is that they're really keen that people don't default into sort of standard boilerplate wording to cover off these areas. So that's a few points around Brexit and COVID. I'm now just going to touch on a couple of other areas of update. First of all, the audit report. Now, you may be wondering why I table this, but there is an interesting change here. So for accounts with periods beginning the 15th of December 2019, so basically December 2020 year ends, the audit report wording will be different, and it's different in two ways. There's more customization there is customization that's required. Typically, the audit report is a standard set of wording. However, now each audit report will have to have customized wording around two areas. First of all, going concern. So the auditor will be having to explain how they evaluated management's assessment and any key observations around going concern. And secondly, around fraud considerations. So the auditor will need to summarise the specific procedures they've performed and the extent to which those are capable of detecting irregularities. The next two areas that I'll just touch on are relevant for large companies, and they're carbon reporting and Section 172 reporting. So in summary, for accounting periods beginning the 1st of April 2019, so basically March 2020 year ends, those year ends will have to have carbon reporting included in the front end of the accounts. The only exceptions being if there's a very low level of carbon usage, or it's not feasible to get the data. So, for example, if you're operating from a shared premises where there's no itemised bills. But if you're a large company, you will need to disclose the energy consumed in the UK, so the gas, electricity and transport, and the associated greenhouse emissions with that. And alongside, you'll need to give some explanations to the methodology behind the calculations that you've made and what they call an intensity measure. So that's carbon emissions linked to a business activity, such as units produced or revenue generated. And finally, you'll also need to disclose the principal efficiency measures that you've undertaken. So, for example, the impact of LED lighting and how much energy you anticipate that will save going forwards. Finally, Section 172 reporting is a new section that will need to be brought into large company sets of accounts. Now, so this is relevant for large companies, but also companies which have 2,000 and more employees. So you could have an unusual situation where you've got a low turnover and low balance sheet total, but still that number of employees. But more significantly, you don't get a group exemption here. With carbon reporting, you would just report on a consolidated level and the subsidiary companies wouldn't. Here, if any single company within a group meets the criteria, that company needs to make this disclosure. And what are these disclosures? Well, it's all about explaining how you have identified who the key stakeholders in the business are. So typically employees, suppliers, customers. How you set about assessing what's important to them and how key decisions you've made have considered their views and the impact on them. There's various detail within Section 172 which needs to be met, so I won't drop down that because that's a sort of a separate level of detail. But from a high level awareness point of view, those are the key considerations to bear in mind. So that brings me to the end of my section, and I'll now hand back to Paul to pick up any final questions. Thank you, Paul.
Thanks, John. Thanks, Wendy, and thanks, Steve. That was a packed seminar of technical detail. As I mentioned at the beginning, we have recorded this seminar, so if you want to familiarise yourself with some of the content, we will send you the link to that seminar, and we'll also use that opportunity to reach out with any answers to any questions that we don't get round to today. We've got a lot of questions come in, so let's dive straight in. A broad question to begin with: how are software services affected by Brexit? John, You may all have views on this from your respective areas. Who wants to go first?
Well, I think from my point of view, as I mentioned, GDPR is going to be the key area just to keep a careful eye on here. We, at the moment, the UK is planning to write GDPR into the UK's law, but from an EU perspective, we're going to become a third country, and therefore, until the EU makes what's called an adequacy decision, the UK will have to make sure that there are appropriate safeguards in place on a situation by situation basis, which basically means a UK company needs to make sure it's got appropriate standard contractual clauses in. This is important where consumer data flows are key to a business as they sort of operate their business. GDPR compliance, it's more of a legal issue, clearly. So again, just noting back to Paul's caveat at the start, it's one that you'll need to talk to your lawyers about. But hopefully that's a sort of a high level observation on one of the practical issues that we are seeing as we discuss this point with our clients. Wendy, is there any VAT angles there, or?
So on VAT, on services generally, it's much less affected than goods transactions. So broadly, B2B software supplies between the UK and the EU will stay zero rated or subject to reverse charge. Only thing to watch out for is if you're supplying electronic services to consumers, you'll already be using a special VAT accounting process called the mini one-stop shop, and the mechanics of how that works will change, but it stays the same in principle.
I'm going to jump on to the next question just to cram some in. So just going back to you, Wendy, there's a couple of questions that came in whilst you were speaking from Amy and Nikki. Sticking with services, is there extra guidance for services?
At the moment, there's very little guidance around on services, but it is kind of back to the first principles of VAT. For example, it used to be the case that you had to, if you were supplying services to a EU consumer, you had to charge them UK VAT. Where that's not an electronic service, that's probably not the case anymore. Most B2B services will stay just about the same. So no guidance as far as I'm aware, but probably no major issues either.
Thank you. We've got a question from Nikki. Thanks for your question, Nikki. Will my IPR registration instantly just cover all activity within the EU that historically was just for the rest of the world?
I wouldn't use the word instantly, I don't think, probably. In principle, if you have got IPR, you should be in a position where you can reclaim duty that you incur on goods coming in from outside the UK that are going out again. But I would look quite carefully at the supply chains around that to make sure that your existing IPR will pick that up, and also at things like the level of guarantee you've got, etc., just to make sure. So yeah, in principle it will, but you need to check the detail.
Great, thank you. We have a question about selling between Germany and France. So we have a German VAT number. If buying in Germany and selling in France, do we need a French VAT number as well?
That's an interesting one, because it's almost exactly the example I used in my presentation when I was talking about triangulation. In principle, again, it's difficult to tell without looking at the transactions in detail, but the fact that you've got a German VAT number should make it easier to deal with the sales to French customers, especially if it's all B2B.
Great. I think this is Nikki again, but let's jump into that one. So is it fair comment that if we trade with rest of the world already exporting, that most things EU will just be as they were historically for the USA and Canada?
Yeah, certainly from a sort of documentation perspective, people who are used to documenting export transactions to the rest of the world will be able to extend those processes to EU customers as well. Just looking out for anything that's maybe a bit different about your EU customers. For example, the point about Incoterms, making sure that they're not expecting you to do the importation and pay the duty. And also if you're moving any goods when they're within the EU, you'd need to look at that. So yeah, broadly true, but again, look at the detail.
Thank you. Teresa's got a question, a very technical question. If I may, Teresa, I think we're probably going to take that one offline. It deserves a technical answer, and I think Wendy will reach out to you if that's okay, separately. Sticking with countries, question about Denmark. So if goods are collected by customer in Denmark, who is responsible for import-export documentation and VAT?
I'm not sure who's in. So if the goods, so I don't know, apologies, if that's the goods are collected from the supplier by the customer, then potentially that's an ex works Incoterm, and it makes the customer responsible for the import-export documentation. Particularly on VAT, you need to watch that if you're supplying goods ex works and letting someone take them away and deal with the documentation. If you want to zero rate that supply for VAT, you'll need to get the export documentation back from your customer. So that's one to watch. Actually, that's quite a risky area.
Thank you. Question from Sarah. I'm conscious of time, so I'm just going to rattle through. We've still got plenty of attendees, so I'm just going to take the license to carry on whilst we've got everyone's attention. Sarah's got a question. Will B2B services to customers in the EU be affected?
Again, broadly, they should stay just about the same. Just watching out for the usual funnies, services relating to land, services relating to admission to events, which have got a different place of supply. But that's the case at the moment as well. So just, yeah, basically the same.
Thank you. The following question, happy to pick off the line. If I may invite Wendy to do that separately. We'll try and work out who that is in relation to scientific trials, but please do reach out to Wendy or drop your name into the comments box, and we'll pick that up separately. Steve, one from Nadia. Do you want to pick that up? What about double tax treaties? Do these expire as at the 1st of January?
Yeah, thanks, Nadia. No, they don't. So the double tax treaties will remain in place, unaffected. So the question is, what do the rates in the double tax treaty say? So, you know, if you're dealing with customers that are not connected to you as a business in any way, then largely the direct tax that you'll pay or suffer will be based on what the double tax treaty rates say as of today, and that will remain from the 1st of January. The key point is that if you're looking at arrangements across connected companies or companies in the same group, then there is a potential problem there.
Thank you. And just one final question, let's squeeze it in at the last, from Sarah. What happens if equipment is hired out to a company in the EU?
I'm guessing that's a VAT question. Yeah, I mean, generally, again, that's going to depend on the detail of the transaction, where the equipment is, whether that's the equipment's moving cross-border. In general terms, the long-term hire will be a general rule service, and so it'll be subject to reverse charge VAT. But you will need to watch out what's happening to the actual equipment if it's crossing the border, and whether a customs duty and VAT liability is going to arise.
Wonderful, thank you. So just to conclude, I'd like to say a huge thank you to everyone for attending today. I hope you found today's seminar informative. I'd like to thank our panel for speaking to you today. As was mentioned several times today, we do have a number of resources on our website, 2 COVID hubs, and we are continually updating those on a live basis with the latest announcements, including those that were announced on Saturday by Boris, and we will continue to do that going forward. So I implore you to look at our website and use those resources. But as I mentioned right at the beginning, we are here to help, so please do reach out to us if you need our assistance. Thank you for everyone for attending, and we look forward to welcoming you on the next webinar. Thank you.